Interest rates are confusing most investors, and the reason for that is most of the talking heads on TV and in the press also are very confused on how interest rates work. First, let's talk about the Federal Reserve. The Federal Reserve is capable, through the federal funds rate, of dictating short-term rates, rates less than 1 year. And currently the Fed funds rate is between a range of 5.25 to 5.5, with an effective rate of 5.33%. This is way down from where it was historically, but way up from where we got to during the middle of the COVID crisis and for much of the 15 years following the financial crisis. So federal fund rates are up from 5.25, from basically zero a couple years ago, but they're still not high by historic means. The federal funds rate acts to impact longer-term interest rates on a delayed effect. And that delayed effect is how much the higher short-term rates will influence borrowing costs, how much people are willing to lend, economic activity, which will then spill over into GDP growth, inflation rates, and those are the things that really impact the long-term interest rate. The Federal Reserve does not have a direct impact on interest rates. And ironically, the lower the federal funds rate, the higher the longer-term interest rate will be over time. And this is because lower short-term federal funds rate causes higher economic activity and higher inflation. Higher federal funds rate slows economic activity, slows inflation, and then allows the long-term part of the curve, the 10 and the 30-year curve, to drift down over time. That usually happens with a delayed impact. Currently, we have some other items hitting long-term interest rates. The U.S. federal government deficit is running at about $1.7 to $2 trillion a year. And as interest rates have reset higher, interest expense on the debt is expected to break $1 trillion, if it has not already done so, but in the very near future run rate. That's $1 trillion that basically is paid out in interest expense, doesn't go to Medicare, Social Security, defense, any actually beneficial items to the American public. The other item is that the Federal Reserve has reversed quantitative easing. So back in 2008, the Federal Reserve's balance sheet was around $800 billion. By April of 2022, it had surged to nearly $8.9 trillion. It is now retraced here as quantitative tightening kicked off at that point in time, and they've reduced it to around a $9 trillion number. Still up massively from where we were in 2008 as the Federal Reserve helped bail out the bank balance sheets through some very generous lending programs and asset purchases. And then we also had another round of quantitative easing during the COVID crisis. And then we had this mini bank crisis earlier this year in March, and the Federal Reserve actually did a brief moment of delaying quantitative tightening and actually going into reverse for a couple months. And that has now since resumed, and the Federal Reserve is running off its balance sheet, but it's, it's well behind schedule for where they anticipate it to be on quantitative tightening. But quantitative tightening means that the Federal Reserve is not buying bonds. They are actually letting the bonds mature. It means somebody else has to buy those bonds as they're refinanced. And the buyers of bonds are becoming more reluctant. You've seen through SWIFT payment system sanctions on Russia. There was some asset capture of Russian assets that were dollar-based. So the world is moving away from a dollar-based system, meaning that the central banks across the globe are less inclined to buy U.S. Treasuries. And sure enough, there's been a decline in U.S. Treasuries. China and Russia being the two biggest ones that have actually reduced their, Treasury holdings, but it's also happening across the globe, including countries that are friendly to the U.S., such as Japan. So fewer buyers by central banks of Treasury bonds. Quantitative tightening has resulted in the Fed actually being a net seller of Treasury bonds. And then you've got this huge deficit, running at $1.7 to $2 trillion a year and only getting bigger. That is also going to require additional financing. So interest rates have reacted sharply, both to a combination of higher inflation and also a combination of supply-demand dynamics. We continue to think that interest rates bias are upward from here, although the bulk of the move is probably behind us. We do think that in a nominal GDP environment of 3% inflation and 3% real GDP growth, that would give you a nominal GDP of around 6%, and that would be a fair value for the 10 and 30-year Treasury, in our opinion. That is where the historic norms have been on market-based pricing on those instruments. I hope you find this information helpful and it clarifies some of the discussion taking place. But remember, higher federal funds rates indicate lower inflation and economic activity, which will in time decrease the longer part of the Treasury bond market. Thanks for your time. Please check our website for our disclaimer, where you can see that this is what we're doing with our own portfolio and is not investment advice. We can also sign up to get text and email alerts, so you'll get this information on a timely basis. Hope you found it helpful and have a great day. Thank you.